Many investors celebrate high returns without realizing that what truly matters is not how much money is made, but how much is kept. Taxes quietly shape outcomes by reducing growth year after year. Two investors can earn the same returns and end with completely different results simply because of tax efficiency. Understanding after-tax returns is not advanced theory. It is essential knowledge. In this video, you will learn why tax efficiency determines real wealth over time. Like and subscribe to continue learning how intelligent planning protects long-term investment success. 1. After-tax returns define real performance. Investment performance only becomes real after taxes are paid. Gross returns are theoretical numbers that do not reflect usable wealth. After-tax returns show what remains available for reinvestment spending or security. Ignoring this reality creates false confidence and poor planning. A strategy that looks strong before tax may fail to deliver meaningful growth after tax. Serious investors judge success by net outcomes. After-tax performance is the only measure that reflects reality and long-term financial strength. 2. Tax efficiency protects compounding power. Compounding works best when capital remains invested for as long as possible. Taxes interrupt this process by removing capital that would otherwise generate future growth. Tax-efficient strategies preserve the base on which compounding operates. Even small improvements in efficiency create large differences over long periods. Investors who prioritize tax efficiency allow time to work fully in their favor. Those who ignore it unknowingly weaken the most powerful force in investing. 3. Equal returns can produce unequal outcomes. Two portfolios can earn identical market returns, yet deliver dramatically different results after tax. The difference lies in structure holding periods and taxable events. One investor reinvests efficiently, while the other leaks value through frequent taxation. Over decades, this gap becomes enormous. Tax efficiency explains why some investors quietly build lasting wealth while others stagnate despite similar performance. Structure matters more than headlines. 4. Turnover is the enemy of tax efficiency. Frequent buying and selling increases taxable events. Each transaction may trigger taxes that reduce available capital. High turnover strategies must overcome this drag just to break even with simpler approaches. Lower turnover allows gains to compound uninterrupted. Tax efficiency often improves when unnecessary activity is reduced. Doing less can produce more after-tax growth. 5. Income timing influences tax impact. The timing of income recognition plays a critical role in tax efficiency. Taxes paid earlier reduce future growth potential. Capital paid later has more time to compound. Strategies that delay taxation legally preserve value. Time is not neutral in taxation. Early payments are more costly than later ones. Intelligent investors design portfolios that respect the time value of money. 6. Inflation makes tax efficiency more important. When inflation rises, taxes become more damaging. Investors may pay tax on gains that only reflect inflation rather than real growth. This reduces purchasing power even when portfolios appear to grow. Tax efficiency helps protect real returns, not just nominal numbers. Understanding this prevents the illusion of progress while wealth quietly erodes. 7. Tax efficiency reduces risk without reducing growth. Improving tax efficiency does not require higher risk. It improves outcomes by reducing unnecessary loss. Investors often chase higher returns instead of protecting what they already earn. Tax efficiency strengthens results without increasing volatility. It is one of the few strategies that improves performance without adding uncertainty. 8. Systems and planning create tax advantage. Tax efficiency is never accidental. It is the outcome of deliberate systems, structured planning, and consistent execution over time. Asset placement, holding periods, and reinvestment strategies all play a critical role in shaping long-term results. Investors who treat tax planning as an integral part of investment design rather than an afterthought achieve smoother and more predictable growth. By building systems that account for taxation from the beginning, guesswork is eliminated and costly mistakes are reduced. Strong planning creates clarity around when to realize gains, when to defer them, and how to reinvest efficiently. Systems replace emotional decision-making with repeatable logic. 9. Net thinking separates professionals from amateurs. Professional investors consistently think in net terms, focusing on what remains after all costs, including taxes, fees, and inefficiencies. Amateurs tend to focus on surface-level returns while ignoring the friction that quietly erodes performance. This difference in perspective compounds into dramatically different outcomes over time. Net thinking forces better decision-making because it prioritizes clarity, efficiency, and long-term impact rather than short-term appearances. Investors who adopt this mindset develop clearer priorities and avoid unnecessary activity that reduces real progress. 10. Tax efficiency builds durable wealth. Durable wealth is built through consistent preservation of gains rather than occasional wins or aggressive speculation. Tax efficiency plays a central role in ensuring that progress is not quietly reversed through recurring losses to friction. By minimizing unnecessary tax exposure, growth is aligned with longevity and sustainability. Investors who understand this focus less on speed and more on stability, recognizing that compounding works best when it is uninterrupted. This approach reduces volatility, strengthens confidence, and creates financial independence that can be maintained over time. Tax efficiency is not about avoiding responsibility. It is about understanding reality. After-tax returns determine what can be reinvested, protected, and used to build long-term security. Investors who respect this principle build wealth quietly and consistently, while others lose ground without noticing. Like and subscribe to continue learning how intelligent structure turns returns into lasting financial strength.